late on their mortgage, their information becomes public at the courthouse. 73 West Flagler, here in Miami, room 133. Okay, so if that individual or that party does not reinstate the property or sell it, 3 months later, it'll have an auction sale date. 3 weeks prior to auction, the information becomes public again. So this is the first stage, this is the second stage, and then the third stage is it goes back to the bank, and we know it as bank REOs, bank real estate owned property. Okay? And what I like to start off with is what we call the tax control triangle. So we have certain investments that we can invest in before Uncle Sam takes away our taxes. How many of you guys work for a corporation? Just one? 2? 3? Most of you, right? I would assume. How many of you guys self-employed? Okay, so less than half. So before Uncle Sam takes away your taxes, so you get a paycheck, if you work for a corporation, before Uncle Sam takes away your taxes, you can invest in a 401k. Okay, if you're a teacher, like Miami-Dade compensates us, and they offer us what's called a tax sheltered annuity. If you're a teacher, if you work for a non-for-profit organization, you get offered a tax sheltered annuity. A traditional IRA, and a simplified employer pension plan. When you sell these investments, you pay taxes on the whole thing because it's a before tax investment. Okay? And then you've got your after tax investments. So you get a paycheck, Uncle Sam takes away their taxes, and now you can invest in real estate. Mutual funds, annuities, stocks, bonds, CDs, money market accounts. What are CDs paying nowadays? About 3% a year. So if they're paying 3% a year, what's inflation going up by every year? About 3.5%. So you're making no money investing in a CD right now. Okay? When you sell these investments, you pay taxes on the profit. So it's an after-tax investment, and then you pay taxes on the profit, so you're paying double taxation. When it comes to real estate, there are certain rules. Okay? If it's your primary home and it's a property that you homestead and you live in it for more than 2 years, then you're exempt from paying the capital gains. If you're single, up to $250,000. If you're married, up to $500,000. Okay? Any questions so far?
If you sell your primary home and you buy another property and you sell it again, does that apply?
If you live in it for 2 years and you sell it and you make a capital gain, are you married or you're single? Okay, if you're married and you make a $500,000 capital gain, you don't have to pay taxes on that capital gain. If you live in that second home for 2 years and you sell it again and you make another $500,000, you're exempt from paying $500,000 capital gain.
Once in a lifetime?
No. If it's your primary home and you live in it for 2 years,
3 years.
You have to live in it for 2 years and you have to claim it as your homestead. If you don't live in it, if it's an investment property, then you would have to pay capital gains tax on the gain unless you do what's called a 1031 exchange. Okay? And the way that a 1031 exchange works is, let's say you bought a property, you sold it for $300,000, and you owe $200,000. That's a $100,000 gain. before you sell that property, you contact an entity which does 1031 exchanges. And at closing, that entity would take this $100,000 and they would put it into an escrow account. Okay? You have 45 days to identify another property or other properties that you intend to buy. You have 180 days to close. Whatever monies you put into your pocket at closing, you're going to pay taxes on.
I'd like to say that as you're explaining this, it sounds very good. But I'd like to retain some of this, and the manner in which you're presenting the material is not affording me the opportunity to retain it, because you're saying a lot of stuff, and a lot of it I've heard before, and I don't write very fast, don't take shorthand, and so that's a handicap for me, and I'd just like to throw that out.
Okay, do you have a question so far? Because we've only have 2 hours. Actually, we have...
I understand that, but I was thinking that maybe there might have been something written or something, and we can just kind of...
You know what? Miami-Dade used to provide us with handouts, and now they just provide me with a chalkboard and a computer and a projector. So you're going to have to bear with me. If you guys have questions, I will be here longer. If you guys don't have questions, then I'm going to fly through this stuff because I already know it. So if you have a question, that's why I ask, are there any questions? So if you have a question so far, I think I've been pretty slow.
Not really. Yeah, I'm understanding what you're saying.
Because some people, know this stuff already, and some people want to get to the nitty-gritty, and I want to be able to provide value for those people that already know this stuff. And that's why I ask, do you have any questions? So far, do you have any questions?
No, but I'm just saying, it's like a conversation that we're having.
Okay.
And, I'd like to remember some of this, so I don't know what the procedure is.
Then I suggest ask questions. So, if...
I will do that.
Okay.
So let's continue.
Sure. Any other questions? No? Okay, so basically, whatever monies, if this is an investment property, so you bought it and you sold it after a year, and it's not your primary residence, it's an investment property. And you have a $100,000 gain. If you want to defer from paying taxes on that gain, you have to hire a company. I would recommend Bayview Financial, and if you guys email me, I'll be more than glad to give you their phone number.
What was the name again?
Bayview Financial. They charge $450 to do a 1031 exchange. Then you have, before you close, you have to hire this entity so that they know where to put this $100,000. Okay, they have to put it in an escrow account. You have 45 days to buy another investment property or other investment properties, and you have 180 days to close. If you don't close within those 180 days, guess what you're going to be paying taxes on? The $100,000 gain.
Is 180 days not 45 days or 180 days?
180 days in total the day you close. So from the day you close, you have 45 days to identify, 180 days to close. Okay? And then you've got after-tax investments, such as a Roth IRA, educational savings accounts, life insurance with savings, so cash value life insurance, and a municipal bond. When you sell these investments, they are potentially tax-free. Okay, the reason I use potentially is because if you take your Roth IRA and you put money into your pocket before you're 59 and a half, then you're going to pay a 10% penalty and you're going to pay taxes on that money you take out. Unless you take out your cost basis, which is the money you took out of your pocket or you invested it from your pocket after 5 years. So I just like to show this because my background is financial planning, and I think this is pretty relevant to what we're talking about, which is taxes. How many of you would like to lower your tax bracket or pay less in taxes? Most of us. So this is another chart that I like to show you guys, and this is called the Rule of 72. How many of you guys have heard of the Rule of 72? A couple of you. If you take the number 72 divided by the interest rate that someone is giving us, it'll tell us the number of years it will take for the money to double. So the bank is paying what on a CD? What are we getting on a CD? Say 3%. If say we're 29 years old today and we invest $5,000 in the bank, 72 divided by 3 is 24 years. So 24 years later, you'll be 53. It'll become $10,000. 24 years later, you'll be 77. It'll become $20,000. How many of you guys have 24-year periods in our lifetime? Not too many of us. Let's say that we were able to get a 6% rate of return. So we invested $5,000. 72 divided by 6 is 12. So 12 years later, you'll have $10,000, $20,000, $40,000. Okay? At 6%. At 12%, it doubles every 6 years. So you'll have 5, 10, 20, 40, 80, 160, $320,000. Okay? And the bank is going to give us how much? This is $20,000 at age 77. This is $320,000 at age 65. Okay? At 18%. Where can we get 18% nowadays? At 18%, the money doubles every 4 years. So 10,000, 20,000, 40, 80, 160, 320, 640, $1,280,000. Let me ask you guys a question. Where do credit cards come from? They come from banks. Is 18% feasible for a credit card company to charge us? Absolutely. So they're charging us, or they're making $1,280,000 out of one person putting $5,000 in the bank, and they're giving us how much? $20,000. Okay? So the reason I show this is because we're trying to make a higher rate of return. And I'm going to try to show you guys how to make a higher rate of return. Any questions so far? No? Okay. What are some of the advantages to buying real estate? What is one advantage? Leverage. Appreciation. Thank you. Okay? Leverage. How much do you need to buy $100,000 worth of Microsoft stock? You need $100,000. Unless you buy on margin and you have a good relationship with your broker-dealer, then you can borrow some of it. But typically you need $100,000. How much do you need to buy $1 million piece of property? $100,000. So let's say you give $100,000 down, you finance $900,000, and it goes up 10%. Okay? The next year, year one, you're up $990,000. Let's say the next year it goes up another 10%, which is your second period. So 99.